Good morning and welcome back to the latest edition of the InvestTalk market analysis for the week ending June 23rd, 2023. Appreciate you all tuning in and subscribing to this channel as well as our podcast, InvestTalk. Been on vacation the past couple of weeks, so I'm back now and excited to go over the market and the economy overall. Now, this week I'm going to title the video Russian Coup Caps a Volatile Week in Equities. And if you've been following the news over the past 18 hours or so, you know that the paramilitary group, the Wagner group in Russia, is trying to overthrow the head of the Russian military, and probably thus Putin. So we'll see how this plays out. It's probably going to be an eternal fight for a little while. I doubt the Wagner group will succeed, but you never know. It's hard to know with Russia. But anyway, we can't really focus on that because the market was closed when that really started to happen. So we'll see how that affects the market on Monday. But I'm Justin Klein, and I'm the host of InvestTalk and CEO of KP Financial, and I'm excited to go over this with you this morning in the markets. So let's see the economic news that came out this week. We had initial jobless claims, and that one, they remained flat, remained in an uptrend, but nothing, too terrible. If you zoom back out 3 years, you see that this still remains at relatively low levels. So it's kind of skewed if you go back, this is pandemic era, but still, pre-pandemic, we were at, in the low 200s, right? On average, sometimes you dipped up in the mid 200s. So we're at 264. It's not something that really you should be too worried about. The job market remains relatively strong. Let me look at continuous claims for unemployment. I think that's another good one to look at. And we've ticked back up. Pre-pandemic, we're at about 1.8 million, or these are the people that are on the unemployment doles, and we're pretty much there, but it's actually been declining, right? So it's not just about the initial job gains, how many jobs are people losing, but are they able to get back to work? And what you're seeing here is that really since April, they have. Okay. And I think a big part of that is the housing market. And everyone said, oh, the housing market's weak. Well, it's weakish, but that's not really what affects the jobs market too much. It's really the new home market. And you saw housing starts come out, and that was up 21% month over month. We've only seen that month over month increase just a handful of times. 2016 we had one. Let's go back to the 80s. We had spikes up that high. But overall, let's go to a 10-year chart just to kind of make that look a little easier. But yeah, October 2016, was this 2015? We had a big spike over 20%. Post-COVID, which is kind of obviously skewed with that big drop and then snap back. But this is just showing that the housing, the home builders sentiment is pretty strong. And that you see that with the Wells Fargo U.S. Housing Market Index. Since the beginning of the year, you've seen the home builders become more and more confident. And existing home sales remain low. Look at this, 4.3 million on an annualized basis. It's pretty much near the lows of where we get, 09, we got down this low and we've stayed there. But remember, existing home inventory remains very depressed. Everyone's calling for a housing crash, and it's very hard when inventory still is very, very low, right? It's ticking up, which is standard in the selling season, right? Spring selling season, you get more people putting their home on the market. But if you look at the month's supply, back in 07, 08, this is when the 06, you saw the inventory really breaking out and the housing market really slumping, and that let me go to let's zoom out actually. And you can see here, this is the existing home inventory. You had nearly 4 million homes on the market. Now you have 1 million homes, right? So everyone's calling for this crash when you have a quarter of the homes in the existing inventory of what we did in 08. And so, yes, you're having problems on the demand side, but you're also having problems on the supply side, which we're going to get to at our webinar coming up next week if you want to tune into that. But I think it's always important to zoom out and look at this in context. And remember, a normal market, housing market, this is pre-08, you had about a 4 to 5 month supply. Remember, this is dividing the number of sales divided by inventory. So how many months would it take to work through the inventory at the current supply level, okay, based on current sales? And so typically it's about 5 months. It's a balanced market. 07, 08, 09, that was not a balanced market. You had 10 months of supply, 10, 11 months supply. Now we're at 3. So that's up from the 1.7 in the end of 2021, which was egregiously low. Now it's just below average. And so it's just hard to get a tough housing market or, really big declines in prices when you have such limited inventory. And so let's go over to the market right now, and I'll just show you IATB, which is the home construction index, and that's just powering higher because the home builders they're about moving product, and they're able to buy points, offer 5% mortgages where that's just not happening elsewhere. So that's kind of a quick overview of the housing market and really the economic news out this week. And it's really hard to see the economy really tanking with the housing market, but new builders market remaining so robust. Okay, now let's take a look at the market as a whole. Here's the NYSE. You had a pullback this week, pretty much every day. This week you had a pullback, and not shocking, right? You're in this kind of trading range. You started to edge up towards the top end of that trading range, and you got a bit of a pullback. The strong dollar certainly helped that pullback, right? So far, over the last 5 trading days, you've seen only one of those days really was a down day in the dollar. And the 10-year, that one remains kind of up here, close to about 3.8%. And you had short-term rates that moved up. Remember this SHY, so when this moves down, that means short-term rates move up. And it was really a lot of job owning from the Fed saying, hey, we need to get inflation down. We're likely to raise 2 more times. This pause last week is just a pause. That's it. So they continue to try to talk big to try to tighten financial conditions a bit, and it worked this week. But you saw that with the housing market data. That is another indicator that, hey, the Fed needs to keep rates higher for longer, and maybe even raise rates again in order to get inflation down. I disagree. I think by the base effects in June and July, that's going to start to get inflation from the 4 handle all the way down to the 3 handle, maybe even the 2 handle by the end of the year, and they're going to start to see that. But that's going to take some time for that to feed into to the data, and they're clearly not seeing that. So it's one of those things where short-term rates are powering a bit higher on the back of a Fed that remains hawkish, and that tightens financial conditions. The VIX, however, that is remaining very low, which when the VIX is low, that means that there's not a lot of fear in the market. So we'll see with this coup how that affects volatility going into next week, but nothing really doing there. Also, the MOVE index, kind of the volatility index of the treasury market. What's interesting is that hawkish rhetoric didn't turn into the MOVE index moving higher, which means that the treasury market is staying intact. What you're seeing here is that with the debt ceiling being raised, the Treasury is issuing more debt, but that's really just coming out of reverse repo, which is not pulling liquidity really out of the market. So it's something that you want to watch for to see if liquidity is drying up. And so far, liquidity remains relatively strong. So I think this is a modest pullback in regards to this up move. We're into resistance. Here's the S&P pullback here. Let me zoom out to a weekly. And this is resistance. When you had this rally here and a breakdown, this line right here, area right here in the 4,400 on the S&P is resistance. So it doesn't shock me to see a pullback and maybe a consolidation period for the next couple of weeks, especially with this uncertainty around the coup. But I do expect more upside into maybe late summer, and then you get maybe a pullback. But so far, so good. You really this recent pullback isn't really something to get too up in arms about. Let's look at the credit markets. You have this is short-term junk bonds to short-term treasuries, and you saw that pullback showing credit spreads widened out a little bit, but nothing too dramatic here, right? Just a modest pullback to that 100-day moving average. So I'm not too worried about that at the current time. If this breaks down below the 50-day, then you start to think, okay, could this be another large leg down? But so far, it's fine. Let's take a look at the I always want to watch this right now, the banking index, KBE. This one's rolling over a bit. So this is probably the biggest worry, is that, the problems in March with the banking crisis is likely to still linger, with rates still higher, and the Fed job owning higher for longer. All right. So that's something to be on watch if that breaks down. Gold is pulled back on the fact of rates staying relatively elevated and the dollar getting a little bit stronger. But overall, this is still in an uptrend, right? Zoom out to a weekly chart, and we went to the high end of the recent range and we pulled back. But until we break below kind of this area right here, the low end of this bar on the gold, it still remains in an uptrend, and this is just a pullback in the midst of an uptrend. Silver to gold ratio, let's take a look at that real quick. This one is the biggest worry, is that this had a pullback. You want this to remain an uptrend. A little bit lower low, so that could be an indicator of more weakness, but overall, this remains in kind of a neutral stance, so nothing too negative or positive on that front. So a little bit murky there. I want to look at commercial mortgage-backed securities. So this is what is happening in the office market, and there's been a lot of talk about that and problems with the banking crisis, right? Pulling back from lending within that space, and this remains intact. Okay, so no real credit issues, credit worries on that front as of yet. So I wanted to highlight that. Overall, I still think we're in this period where the market's going to remain choppy into resistance, but liquidity dynamics remain strong. You're going to get weeks where you get a pullback, where you get a little bit stronger dollar, you get higher short-term interest rates, especially when the Fed's job owning. But liquidity turns in the fall, and that's why you've seen equities rally. You've seen the credit markets hold together. You obviously have issues with the commercial banking market, but it's not anything that is pulling the market apart, especially with low unemployment and people putting money. Remember, when people are employed, what are they doing? They're contributing to the 401ks. They have a QDIA, which is basically the indexes, and so money just flows in the indexes. So, and then you have money market accounts that are have highest levels of cash in history. So there's a lot of dollars out there. There's a lot of flow into equities, and so it takes really a labor market that's weakening significantly, and it takes more money into the market. Right? There's too much money in the sidelines to have a major decline in equities. So those two factors are kind of holding together, and that's why the market, I think, is holding together. Once again, you're going to have pullbacks, and that's just the nature of a modest kind of weak rally that we have since October. So I think eventually it can roll over, but so far you have to still remain neutral to bullish in the near term due to those liquidity dynamics. All right, I think that does it for me this week. It's good to be back. Appreciate you all for tuning in. And a reminder, the contents of this video are for educational purposes only, should not be construed as a recommendation of buy or sell a security or to participate in an investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Have a great weekend.